Hello options traders, welcome everyone. Well, it was a bit of a sell-off yesterday to say the least. I'm talking of course about August 5th, 2019, when the S&P 500 was down about 3% on the news of more tariffs. It's not the first time we've seen these headlines, but in all cases, we typically get negative reactions. So if tariffs are touted to be so good, or at least that's the way they're sold, and they say, well, for example, the auto manufacturers will get more revenue and they'll have more money and employees will have more money and they'll spend more money and everybody will have more money. It's this virtuous circle of ever increasing prosperity. And that's an absolute myth. And one of the things you have to understand and to learn about economics is that whenever you change supply, change demand, change price, that it sets a lot of wheels in motion. And you can't just say, well, if the auto manufacturers are being helped, we must be better off. That's not true. So let's take a look at why tariffs are bad and why the markets sell off on the news. To do this, we're going to have to go back to some basic economics, which you probably all recognize these graphs from econ classes. And it's going to get a little technical, but just try to follow along the best that you can, because it's actually quite interesting of why markets don't like tariffs. But what we're looking at here on the vertical scale are prices, and I'm just going to use cars as an example. And over here on the horizontal are the number of units. Now this is always per unit of time. So this is, let's say, the number of cars sold per day, per week, per month, per year. It's just some number, but it's a given unit of time. Up here, we got a couple of lines. The blue one here is the supply line. This is going to be for the US. So this might represent Ford and GM. These are US suppliers or manufacturers. And the gray line right here, this downward sloping one, is what we call the demand or the buy side. So this would be people like you and me who are out there buying cars. We are demanders of cars. And so the reason that this blue line is upward sloping has to do with a basic law of economics. It says that as prices rise, suppliers get more motivated, and they're going to bring more goods to market for sale. So for example, let's say that the average price of cars, let's say, is $20,000 in the market. Our manufacturers might say, all right, well, we're willing to produce 200 units. And again, this is over some unit of time, let's say per month. But if the price is increased to here, maybe 25,000, yeah, we're going to get a little more motivated. We have more profits. We can buy higher priced materials. We're willing to sell more. So notice that that has shifted the amount of production out here to the right. So suppliers act positively to higher prices. You and I, on the other hand, the demanders, act in the opposite way. We like lower prices. So let's say that the price is up here at 40,000. We might say, okay, we're willing to buy 200 units or 200 cars per month. But if the price is lower, down here maybe to 35,000, yep, we might buy 250. So again, we have increased the amount of production if prices are lowered, at least from the buy side. And that's why this gray line is sloping downwards. It shows that we like lower prices. So where's the market going to balance? It's going to be right here where X marks the spot. So on my graph right here, at a price of $30,000, we're going to get 300 units sold per month. And we know that because there's no other price on the board here that will maximize the revenues. The sellers have no incentive to move off this price. So everyone who wants to sell a car at this price can, and everyone who wants to buy a car at this price can. There's no leftovers or surpluses. There's no shortages. The market clears. All right, now here's where things start to get a little tricky, but just again, try to follow along the best you can. This little triangle right here is called consumer surplus. And that's just a fancy term in economics that just think of it as a benefit that we get as buyers. And what it means is that, for instance, did we have people who were willing to pay $50,000? Yes, they were right there on that gray line, but they only had to pay $30,000. That's a big benefit. Did we have people willing to pay $49,000? Yep, they were right there, but they only had to pay $30,000. Did we have people willing to pay $40,000? Yep, again, they only had to pay 30. So there's this benefit all the way up, right up here to the X, what's called the marginal buyer, the person who is willing to pay 30,000 and could in fact pay exactly 30,000. But the point is that in really almost everything that you buy, there's a little bit of consumer surplus, because if you really think about it, if you had to, that next item that you buy, whatever it may be, if it was even a couple of dollars more, would you have purchased it? Probably. And so that means you gained some consumer surplus. And that's certainly a benefit to society. On the flip side of our equilibrium arrow right here of this price is the same idea but for producers. This is called producer surplus. Same idea. We had, let's say, some people who were willing to supply cars at 10,000, but hey, out here in the market, they're getting 30,000. That's a benefit to them. And yes, we also had people willing to sell for 15,000 right here on this blue line, but they were getting 30,000. People willing to sell at 20, but again getting 30, all the way up here to the marginal producer, the factory who was willing to sell for 30,000 and was in fact receiving 30,000. So there's a lot of benefit here to the producers. So this entire triangle right here that we saw of the consumer surplus and the producer surplus is a benefit to society, and that is maximized right here at the equilibrium level. All right, now let's clear off our graph a little bit, and let's say that we open up our doors to trade with the rest of the world. Remember, the way that I've drawn this blue line, the supply line, and this gray demand line are only for the US. That's important. But now we open up our borders to trade. And let's say we're going to say, yes, Toyota, Mazda, Nissan, all you guys can come in here. And what that's going to do is, let's say it drives the price of cars down to 20,000. But notice that my supply line right here in red is the supply line for the world. But it's flat. It's not sloping upwards like it does for the US. Why is that? Well, when we bring the world in to satisfy this demand, this scale is super small to the world. Might not be small for the US, but it's small for the world. So the world is saying, 20,000 bucks, we got you. What do you need? 100, 200, 500, 1,000? Doesn't matter. We got you covered. It's flat. So the first thing to notice is that at this new lower price of 20,000, the US manufacturers are now only willing to produce 200 units, right? We read that off of this blue curve. So at 20,000, US manufacturers say, nope, I'm only motivated to produce 200 units. But at that same price of 20,000, we look over to the demand side and we see that consumers are willing to buy 400. Well, how is it possible that we can buy 400 units in a month when the US is only producing 200? How is this gap right here being filled? That's the imports. That's the size of the imports right there, is that green box. But now take a look at what happened to our consumer surplus. It's really big. Consumers greatly benefited from this. We used to have this smaller triangle right here, but now we've got this much larger one. But how did producers get affected? They've been reduced to this little triangle down here. Remember, they used to have this big triangle of producer surplus, but now it's this little tiny one down here. So on one hand, yes, the producers did get harmed from the imports, but we benefited. Economists believe that everybody matters and everybody matters equally. So is it really a bad policy if, let's say, the auto manufacturers that might represent a small fraction of the population are harmed when 99% of the population benefits? See, that's the side that people don't hear. They just say, oh, auto manufacturers are being harmed. We're going to be better off if we can give them more money. That's not true, because that means that you and I have less money. I often say, for example, if the average price of a car is $30,000, yes, that might help U.S. auto manufacturers. But if it's $20,000 and I can now buy a car and I can buy a boat for that same $30,000, by imposing a tariff to make the auto manufacturers better off, you are necessarily making the boat manufacturers worse off. So that's why it's very misleading when you read these headlines saying, well, tariffs are good because it's going to help the auto producers. Well, you might as well make that headline saying, we're going to harm the boat manufacturers. because there's always somebody in society who is going to be affected. Lots of wheels get turned in there. So for whatever reason, the government says, we'd like to increase the size of this triangle. We want to help our domestic auto producers. And we're going to do that by artificially raising the price. So what happens with a tariff is that this red supply line gets shifted higher by the amount of the tariff. Now, the way that I've drawn it, this would be an incredibly large tariff. I've drawn it from 20,000 to about 28,000, but I'm doing that just to make it easier to read. So what's the first thing that happens with the higher tariff? First of all, notice U.S. manufacturers, yes, are going to step up to the plate and say, hey, listen, if cars are now at, let's say, 28,000, we're willing to produce, let's say, roughly 250. But the U.S. consumers, the demanders over here on the gray line, are saying at the higher price, we're only willing to buy this many units. So again, how is it possible that the U.S. can only produce this many units, let's say maybe 260 or 270, and yet we're willing to buy maybe 320? How is this gap right here being filled? That is the size of the imports after the tariff. So notice that they've been squeezed. Over here on the left, we're squeezing it because the U.S. manufacturers are now manufacturing more. And over on the right, it's being squeezed in this direction because we're willing to buy fewer of the imports at the now higher prices. So let's go back to the original consumer surplus. It used to be this great big triangle right here, and I know the graph is getting kind of messy, but it was this big triangle right there. And now it's been reduced to this one right here. So in essence, we have now lost this area right in here, that trapezoid shape right there between the green line down here to the red, over here to the gray. That area has been lost, but it's been transferred. Hasn't really been permanently lost. Part of it has been transferred to the U.S. producers, and that's this little trapezoid right here. And that was the intent of the tariff, was to transfer some of that surplus back to producers. This area in here was lost to consumers, but it was now gained to the government as revenue. So this is the revenue that they gained from the tariff in this yellow box. But notice that there's still two missing triangles, this one and this one. And in economics, that is what's called a deadweight loss. It represents trade that would have taken place if prices remained lower, that never will take place. And that means it's lost economic activity. And the bigger problem is just as it is when we have negative GDP, is that you cannot get that back. You cannot regain lost time. So this production is lost forever. Those revenues are lost forever. Any gains that we would have had from that is lost forever. And it's really damaging to markets. So there's no question, unequivocally, that the U.S. has been harmed by the tariff, even though the government's going to say, well, it's better for everyone because our auto manufacturers have more money and their employees have more money and everybody now has more money. It's absolutely false. There is a deadweight loss whenever you have a tariff. Now, on a bigger level, not only are tariffs bad just because of deadweight loss to society, markets are always going to retaliate. And that's probably the biggest reason why tariffs never work. And that's what leads to headlines like this. It might sound good to say, hey, everyone, our auto manufacturers are being helped, but now our agricultural sector is being harmed. Is that necessarily good for society? To say we're going to benefit one segment, especially if it means a net loss to the nation? Not at all. And in fact, retaliation is almost in 100% of the cases over the last 100 years the course of action you're going to see. So that's another reason that tariffs just don't work. Markets don't like them. But even more interestingly, remember there's a lot of gears that get turned when supply, demand, and prices get changed. Markets will always try to find a way to get goods and services to others at the cheapest possible price. And that's going to lead to headlines like this. Sure, people are going to try to find ways to avoid the tariffs. And so all of the revenue that the government thought it was going to get is going to be lost revenue from the industries that are harmed from retaliation, and also from people finding ways to avoid the tariffs altogether. And so that is why markets do not like tariffs, even though their governments will say they are beneficial. If you'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and strategy lab at optionsaToZ.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.